Morning light cuts across the silver desks of the commodities floor. Screens blink. Numbers jump. Not just a tick up or down, a jolt. Traders glance sideways, fingers poised, coffee forgotten. Markets don't blink at headlines. They blink when the undercurrent shifts. You've heard it. Silver is volatile, unpredictable, unreliable. That's true. But here's the thing. It's never been about the wild swings themselves. It's about the reason no one is paying attention to the pivot points underneath. Look past the daily chatter. Ignore the rally-failed headlines. The question isn't whether silver goes up or down. It's whether the framework of the market itself is flexing, cracking, or evolving. Consider this. Silver wears two hats at the same time. One, a monetary hedge, a refuge when currencies wobble. Two, an industrial linchpin embedded in solar panels, electric vehicles, semiconductors, medical equipment, the guts of modern economies. When both worlds tug at the same metal, prices twitch. When positions unwind, it snaps. And sometimes what seems like chaos is simply the market realigning to forces most investors haven't even noticed yet. Markets don't fear bad news. They fear what most people aren't watching: the hidden tensions, the gaps between expectation and reality. In January, silver prices dropped sharply over a matter of days. From the peak early in the month to the trough, the decline approached 15 to 18%, depending on the contract. The movement was concentrated, fast, and largely driven by the unwinding of leveraged futures positions. Margin requirements on key exchanges were raised. Positions that had been heavily leveraged were forced to close, triggering a cascade of paper selling. Physical silver, meanwhile, responded more slowly. Inventories registered for delivery, the metal actually available in exchange vaults, remained between 80 and 86 million ounces. Open interest, representing claims on silver in futures contracts, exceeded 570 million ounces. Each physical ounce was effectively claimed multiple times. This created a mechanical pressure on the market as paper positions had to reconcile with the actual supply. The structural deficit of silver, observed annually since 2021, persisted. Estimates suggest yearly shortfalls between 110 and 300 million ounces. Cumulatively, the deficit from 2021 through 2025 reached roughly 820 to 1,000 million ounces. This gap indicates that demand has been met by drawing down existing inventories rather than relying solely on newly mined production. Global supply continues to reflect an asymmetry. Around 70% of silver production is byproduct from mining other metals: copper, gold, lead, zinc, and production decisions are dictated by those primary metals rather than silver itself. Consequently, higher silver prices do not automatically generate additional supply. Industrial demand accounted for roughly 60% of total silver consumption. Solar panels alone consume between 200 and 250 million ounces annually. Additional demand comes from electric vehicles, semiconductors, electronics, and broader electrification infrastructure. Unlike investment demand, this industrial use cannot be paused without impacting production processes. Finally, regional dynamics have shifted. For example, China has tightened export controls on refined silver, retaining more metal domestically. Premiums between regions now reflect variations in physical availability, not just theoretical pricing or arbitrage. In sum, the January price drop was less about changing fundamentals in industrial use or supply deficits, and more about mechanical unwinding in financial markets, interacting with a market structure that is already constrained in terms of physical availability. When silver drops sharply, it's not just a number on a screen. The first impact lands on leveraged traders. Positions in futures contracts are marked to market. Margin calls hit. Some traders are forced to liquidate, even if they see value long-term. That forced selling pushes prices lower. Next, the physical market reacts, but more slowly. Vault inventories are finite. When multiple claims exist for each ounce, any attempt to take delivery must navigate a queue. Premiums rise in regions where supply is tight. Localized shortages can appear, even if global production hasn't changed. Industrial users experience a different effect. Manufacturers of solar panels, EV batteries, and electronics rely on consistent silver supply. They cannot pause production without cost. If spot prices spike after a paper-driven drop, purchasing becomes more expensive. Procurement teams scramble, contracts adjust, and some production schedules shift. That's a ripple effect. One market action leads to changes in manufacturing flows, which may impact timelines for projects dependent on silver. Investors who hold silver as a hedge face a different chain. When financial positions unwind and prices drop, portfolios react. Those portfolios often influence collateral requirements in other markets, nudging liquidity needs elsewhere. A drop in silver alone can subtly affect margin requirements in connected commodities and financial instruments. Even broader, regional dynamics come into play. Export controls, like those recently tightened in China, mean some markets cannot access physical metal easily. A decline in U.S. futures prices doesn't immediately translate into cheaper metal for manufacturers in Asia or Europe. Arbitrage exists, but friction, shipping, storage, regulatory compliance slows it. The combination of these forces, leverage trading, physical availability constraints, industrial consumption, and regional market frictions, creates a network of cause and effect. It's not a single headline move, it's a chain reaction. Each link depends on the one before. Financial positions unwind, leads to inventory tension rises, leads to industrial users adjust, leads to regional disparities. Magnify leads to broader market sentiment shifts. Understanding this chain is critical. It's why price alone doesn't tell the story. Investors, manufacturers, and policymakers must observe structural cues, inventory levels, open interest ratios, industrial consumption rates, and regional trade restrictions. These are the levers through which market shifts propagate, not mere daily price charts. In other words, silver's January drop mattered not because it was sudden, but because it tested the system, the balance between paper positions and physical metal, between industrial reliance and financial speculation. How participants respond determines whether volatility is temporary or signals deeper adjustments. Silver has seen sharp corrections before, but context matters. Take the 1970s. In the middle of that decade, silver experienced a roughly 45% correction within an ongoing bull market. At the time, headlines suggested the rally was over. Traders panicked, futures positions unwound, physical premiums fluctuated. Yet history shows that was not the end. The market paused, inventories adjusted, industrial demand continued, and the final phase of the bull run produced some of the most significant gains in the decade. The mechanism, leveraged positions closing, prices pulling back, was familiar. But the underlying drivers, rising inflation, expanding industrial and monetary demand, remained intact. Contrast this with 2011. Silver reached a peak, leveraged positions unwound, and prices fell sharply. But macro conditions had shifted. Real interest rates were rising, monetary policy tightened, and the forces fueling the bull market were reversing. In this case, a similar mechanical drop coincided with a structural change in the market's broader environment. Comparing these episodes to today highlights the difference between mechanics and fundamentals. Past corrections within bull markets show that sharp declines can be part of an ongoing cycle. But other instances, like 2011, illustrate that a decline can coincide with changing underlying drivers. What is new in the current market is the persistent structural deficit. 5 consecutive years of annual shortfalls, totaling 820 to 1,000 million ounces, is unprecedented in modern history. Industrial demand now dominates total consumption, and a significant portion of production is byproduct, not responsive to silver price. Meanwhile, regional export policies, like those in China, have begun influencing where physical metal can move. History provides perspective. It tells us mechanical price swings are common, recurring, and not necessarily catastrophic. But each cycle occurs within its own environment. Recognizing which elements are recurring and which are unique allows investors and analysts to distinguish between noise and structural signals. Bull case. If industrial demand continues to grow steadily, particularly in solar panels and electric vehicles, and if supply remains constrained by the byproduct nature of most production, then silver could experience upward pressure over the medium term. If inventories are further drawn down, regional premiums may widen, creating localized scarcity that reinforces physical demand. If leveraged positions rebuild cautiously, the market might absorb price rises without triggering abrupt mechanical sell-offs. In this scenario, the dual role of silver, as monetary hedge and industrial input, aligns, giving the metal resilience to short-term corrections while supporting gradual strength. Base case. If supply and demand stabilize near current levels, and paper market positions continue to reflect claims significantly larger than available physical silver, then prices are likely to fluctuate within a defined range. If mechanical adjustments, such as margin calls, occur periodically, they may produce temporary volatility without fundamentally changing the broader trend. Industrial users would continue to consume steadily, and regional frictions, such as export controls, may maintain modest premiums. In this scenario, the market continues to test its structure, responding to stress points without dramatic repricing, while participants adjust strategies cautiously. Bear case. If a combination of macroeconomic tightening, such as rising real interest rates or shifts in monetary policy, reduces investment demand significantly, and if leveraged positions are rapidly unwound, then silver could experience a sharper and more prolonged decline. If physical deliveries become concentrated in specific regions and industrial consumption faces substitution or slowdown, then the market's structural deficit might no longer offset downward pressure. If sentiment worsens and confidence in paper positions weakens, then both futures and physical premiums could collapse, amplifying volatility. In this scenario, price movements are more sensitive to both financial and structural shifts, testing the market's ability to reconcile claims with actual supply. Across all scenarios, the key drivers remain the same: structural deficit, industrial demand, regional constraints, and financial market mechanics. What changes is the balance of these factors. If one dominates over others, the market's behavior will shift accordingly. Each conditional pathway illustrates that outcomes are probabilistic, not predetermined. Prices may move sharply or remain range-bound depending on how these forces interact and how participants respond. The scenarios also highlight the importance of positioning and physical ownership. If holdings are predominantly financial claims rather than physical metal, exposure to mechanical stress is greater. Conversely, those with allocated physical silver may experience a different risk profile, especially if delivery becomes more relevant. By framing outcomes in this way, we focus on risk awareness and system mechanics rather than speculation, maintaining professional discipline while acknowledging uncertainty. When I track silver, I look beyond price charts. I focus on structural cues, market behavior, and macro indicators that drive real impact. Here's what matters most right now. 1. US dollar index, DXY. Silver is priced in dollars. If the dollar strengthens, silver often weakens on a relative basis. If the dollar softens, industrial buyers and investors may see silver as more affordable. Movements in DXY can shift sentiment quickly, particularly in futures markets where leveraged positions respond instantly. 2. Treasury yields, real yields, particularly on 5- and 10-year treasuries, influence silver's appeal as a non-interest-bearing asset. Rising yields can reduce investment demand, while falling yields may make silver relatively more attractive. Changes in yields also affect the cost of holding leveraged positions, influencing mechanical pressure in paper markets. 3. Inflation data, CPI/PCE. If inflation indicators rise, silver's role as a hedge becomes more relevant. Industrial demand is mostly fixed, but investment demand responds to perceived currency erosion. CPI and PCE figures provide the context for how investors might shift allocations toward tangible assets like silver. 4. Volume and liquidity. Watching trading volumes across major exchanges helps gauge stress. If volume spikes during price declines, it indicates forced liquidation. Conversely, low volume during rising prices can signal fragile strength. Liquidity measures show whether physical and paper markets can absorb large trades without creating outsized moves. 5. Open interest and positioning. The ratio of open interest to available physical silver highlights structural tension. If claims on silver far exceed deliverable ounces, the market is more sensitive to margin calls or delivery demands. Tracking the buildup or unwind of large positions reveals where mechanical pressure may appear next. 6. Regional flows and premiums. Physical premiums in Asia, Europe, and North America show where metal is tight. If premiums diverge sharply, it indicates localized shortages or hoarding. Export controls or regional policies, like China's recent moves, influence these dynamics directly. Monitoring these indicators lets me see where the stress points are and how participants may respond. It's not about predicting exact prices, it's about understanding the levers that shape market behavior. Watching these dynamics is like reading the currents under a river. The surface may ripple violently, but the deeper flow tells the story. Patience and observation are key. Positions in physical silver react differently than paper claims. Knowing what you hold shapes exposure to sudden shifts. This isn't investment advice. It's simply how I'm reading the market right now. Focus on risk management, patience, and long-term thinking. Track the structural cues, not just the headlines. Respect the mechanics. Let the market reveal its stress points gradually. And when it moves again, make sure you're responding to reality, not to the noise.